Hello everybody. At this time we are talking about concepts of revenue. In economics, revenue and costs are two fundamental concepts that are essential for understanding the financial performance of a business. Revenue refers to the income generated from the sale of goods and services, while cost refers to the expenses incurred in the production of those goods and services. And then key points related to the revenue concept. The first point, recognition. Revenue is typically recognized when it is earned and realized or realizable. This means that revenue is recognized when the company has fulfilled its obligations under the transactions and it can reasonably expect to receive payment for the goods sold or services rendered. And then second, revenue streams in different industries. Revenue models vary across industries. For example, in the software industry, revenue may be generated through software licensing or subscription fees. E-commerce companies often rely on online sales, while media companies may generate revenue through advertising, subscriptions, or content licensing. And then third, types of revenue. Revenue can come from various sources, including the sale of products, fees for services rendered, rental income, interest income, royalties, licensing fees, and commissions, among others. Different businesses may have different revenue streams depending on their industry and operations. Fourth, revenue management. Businesses may employ revenue management strategies to optimize their revenue generation. This includes setting prices, managing demand, implementing promotions or discounts, and utilizing pricing models to maximize profitability. And fifth, importance for financial analysis. Revenue is a critical element in financial analysis as it is used to calculate various performance indicators and ratios. For example, gross margin and net margin are ratios that indicate a company's profitability by comparing revenue to the cost of goods sold or total expenses, respectively. Revenue growth rates are also closely monitored to assess a company's expansion and market performance. And then move to features of revenue recognition concept. The revenue recognition concept is characterized by several key features that guide the proper identification and recording of revenue in financial statements. These features help ensure that financial reporting accurately reflects the economic substance of transactions. There are the main features of the revenue recognition concept. The first, timing of recognition. One of the primary features of the revenue recognition concept is its emphasis on the timing of revenue recognition. Revenue should be recognized when it is earned, indicating that the goods have been rendered or other criteria for revenue recognition have been met. This is irrespective of when the actual cash payment is received. And the second, fair measurement. Another feature involves the fair measurement of recognized revenue. The amount of recognized should be the fair value of the consideration received or receivable. These considerations may include cash, receivables, or other non-cash assets, taking into account any trade discounts, volume rebates, and potential returns. Third, realization of revenue. The concept requires the realization of revenue, indicating that the company has substantially completed its obligations and is entitled to the benefits represented by the revenue. In other words, revenue is recognized when there is reasonable certainty regarding the collection of the associated cash or other receivables. Fourth, consistency in application. Consistency is a crucial feature of the revenue recognition concept. Companies are encouraged to apply consistent methods for recognizing revenue, ensuring that similar transactions are treated in a uniform across financial periods. This consistency enhances comparability and enables stakeholders to analyze financial performance trends more accurately. And then we move to strategies to increase revenue. The first strategy, diversify your product or service offerings. Adding new offerings may help you reach new customers or meet more needs of your current ones. For example, a coffee shop might sell branded merchandise, or a service provider could introduce subscriptions or packages to increase requiring revenue. And then the second, review your pricing strategy. Small pricing changes may make a big impact. Consider bundling, offering tiered options, or adjusting prices based on the value you provide. Be mindful of how changes affect demand and customers' perception. Third, improve your marketing efforts. Effective marketing brings in more potential customers. Use tools like social media, email campaigns, and SEO to boost visibility. Promotions, loyalty programs, or reward incentives may also drive both new and repeat business. Fourth, upsell and cross-sell. Encouraging customers to buy more or upgrade may increase each transaction's value. For example, a retailer might suggest related products, or a software company could offer premium plans. Just be sure your recommendations are relevant and helpful. And fifth, focus on customers' experience. Satisfied customers spend more, return often, and refer others. Focus on improving service, streamlining the buying process, and asking for feedback to build loyalty and keep your customers engaged. I think it is enough. Thanks for watching.